Hi, I'm Audrey.
And I'm Cody.
In this video, we will discuss what affects returns for specific stocks.
Broad themes and trends are often discussed in the media as reasons the stock market or part of the market is surging or performing poorly.
It can be easy to forget that stock markets rise and fall due to the behavior of specific stocks that make up the market.
Many of these themes, often referred to as macroeconomic or macro factors, affect specific stocks as well as the stock market as a whole, such as interest rates, economic growth, inflation, and government policies.
The impact of these macro factors have on stocks can be influenced by something called the business cycle. The business cycle is based on the idea that economies can exhibit a cyclical pattern and rotate through different cycle phases over time.
To demonstrate cyclicality, let's pretend this roller coaster is the economy. Notice how the economy, or the roller coaster, passes through less successful periods or reductions, followed by successful periods or increases, and this happens over and over. Now that we know what cyclical means, let's dive deeper into the business cycle. Audrey, break it down for us.
Of course, I like to draw similarities between the business cycle and seasons, because economies exhibit a cyclical pattern and rotate through different cycle phases over time, just like the seasons. Kind of like how certain jacket styles are better suited for some seasons than others. Some investments tend to perform better than others depending on the market environment or where we are in the business cycle.
It's worth noting that no single investment works all the time, and returns tend to be cyclical. The good news is that we can diversify our investment portfolios with securities and asset classes that tend to be driven by different market conditions and therefore tend to pay off at different times.
The commonly known business cycle phases are the early cycle, when economic activity recovers, the mid-cycle, when economic growth peaks, the late cycle, when economic growth slows, and recession, when economic growth is negative. The macroeconomic changes that typically occur in each phase can have repeatable effects on stock returns.
Of course, there are other factors affecting individual stock returns. One is investor sentiment, which is how investors feel about the overall trajectory of a particular stock or market.
For example, early in a business cycle, investors often expect stock prices to rise and companies to grow, and may be willing to buy more stock to match this expectation, pushing up stock markets as a whole.
During recessions, however, investor sentiment is often poor and can lead to lower stock prices.
The timing of future business cycles is difficult to predict correctly.
How investors perceive the timing and severity of upcoming business cycles is part of what drives business and stock market cycles.
Two common types of market cycles or phases are bull markets and bear markets.
Bull markets occur when stock prices and markets are consistently rising.
Bear markets are the opposite, when stock markets and prices are falling.
A sideways market occurs when stock markets do not exhibit a strong trend up or down, but that does not mean that specific stocks are not changing. Sort of like when you're hiking and you hit a flat terrain for a period of time.
But what indicates how well an individual company is performing within the overall market?
Company profits or earnings are a key factor in determining a company's stock price and the potential returns that a company generates for its investors. As a result, investors will pay close attention to a company's current and past earnings.
For example, if investors anticipate a company's earnings will grow significantly in the future, they may be willing to pay a higher price for that company's stock today.
That's because they expect the stock price to rise as earnings are reinvested into the business or paid to investors as dividends.
Another thing that can influence returns for specific stocks is company news. Stock prices, and therefore stock returns, can easily be affected by company news because it can have an impact on future company profits.
That's right. For example, if you heard that Cody's lemonade stand uses freshly picked lemons and Audrey's lemonade stand down the street uses old, rotten lemons,
hey,
wouldn't you be willing to pay less for shares in Audrey's lemonade stand?
It's important to note that stocks that are more closely followed, such as large, well-known companies, can have their prices reflect recent news faster than those that are smaller, lesser known, and less closely followed by investors.
So what if you're trying to decide between two or more company shares, but each is priced differently and has different levels of earnings? How could you compare those companies?
One approach would be to compare their respective price-to-earnings ratios.
The price-to-earnings ratio, or PE ratio, tells you how expensive a company's stock is as defined by its share price relative to the earnings that company generates.
Comparing various companies' PE ratios can help investors determine whether a company's shares are attractively priced. For example, if a company has a higher PE ratio than its competitors, that suggests the company's stock is more expensive relative to its peers.
PE ratios are also often referred to as multiples, given that the PE ratio represents the number of times a company's earnings would have to be multiplied to arrive at that company's stock price.
Multiples can be useful because they allow investors to compare the value of different stocks to one another, even if their stock prices are very different. For example, let's say you want to compare the price of a small bag with 3 apples from Apple Farm Co. and a big bag of apples with 10 apples from Big Red Co.
The 2 bags have different prices, making it difficult to compare how much you're paying for one apple.
But by looking at the ratio, you can determine the actual value of the apples, making it easier to compare between the 2 choices.
Companies in the same industry tend to have similar multiples, but multiples for different industries can be quite different from one another for many reasons, including investor sentiment and growth prospects.
Going back to our Apple analogy, the multiples for apples from different producers should be somewhat similar.
However, if you were to compare an Apple multiple with a steak multiple, they would look very different.
As you can tell by now, the list of things that influence stock markets is almost endless and can be very confusing at times. But remember, if it were easy to predict, there wouldn't be a stock market at all, and I'd be rich.
Thank you for joining us today. Make sure to continue following along with our videos to learn more about investing. Have a great day.